Hey guys, so today we're going to talk about residential mortgages, and this will be specific to Florida. If you are preparing to take your real estate exams for Florida, you want to check out this entire video. We're going to be doing 10 questions, and if you can answer these 10 questions, then you should be able to get all the questions right on your exam concerning residential mortgages. Now, you should know that the exam has about 9 questions on residential mortgages, and this is for the 2025 exam. You're going to get about 9 questions on residential mortgages, right? So let's jump right into the questions and let's see how you do. Okay, question 1. Sarah purchased a home in Florida and signed a promissory note and mortgage. 2 years later, she defaults on her payments. During foreclosure proceedings, Sarah argues that she should be able to remain in the property until the court finalizes the foreclosure. Which legal theory supports her position? A. Intermediate theory. Sarah has equitable title until foreclosure is complete. B. Title theory. Sarah never held title and must vacate immediately. C. Lien theory. Sarah retains legal and equitable title until foreclosure is complete. And D. Redemption theory. Sarah can stay indefinitely if she makes partial payments. All right, I'm going to give you a second to just look over the answers and decide which one is the correct answer. All right. Okay, if you said C, you are correct. C is the correct answer. This is the lien theory, which says that Sarah does retain both legal and equitable title until the foreclosure is complete. So Florida goes by the lien theory that says that you have both equitable and legal title once you own property, real property in Florida. Okay, moving on. Question number 2. Marcus is reviewing closing documents for his new home purchase. He signs a document that creates a personal obligation to repay the debt and includes the loan amount, interest rate, and payment schedule. His spouse, who is not on the title, also signs the same document. What document did they sign? A. The mortgage because it secures the debt. B. The promissory note because it creates personal liability. C. The deed of trust because it involves multiple parties. Or D. The satisfaction of mortgage because both parties signed. Okay, let's see how you do with this one. All right, the correct answer is B. They signed the promissory note because it creates personal liability. So the promissory note is the note that obligates the borrowers to repay the debt, and it includes the loan amount, the interest rate, and the payment schedule. All right, that's what you will see on a promissory note. All right, let's jump to question 3. Jennifer has been making mortgage payments on time for 3 years. She then decides to sell her home to her cousin Thomas, who agrees to take over the payments without notifying the lender. The lender discovers the transfer and demands immediate payment of the entire loan balance. Which clause allows the lender to do this? All right, so when you are doing these questions, I want you to pay attention to all the details. Okay, what is this describing? When you read this question, what comes to mind? Okay, your answer options are A, defeasance clause, B, subordination clause, C, acceleration clause combined with alienation or due on sale clause, and D, prepayment clause. Okay, the correct answer is C, acceleration clause combined with alienation or due on sale clause. All right, it's not a defeasance clause because the defeasance clause has to do with removing the mortgage lien once the mortgage is repaid as agreed. Subordination clause has to do with the priority of the lien, whether it's the first priority or it's a junior lien. Okay. And D, prepayment clause, has to do with whether or not you will be allowed to make prepayments on your mortgage and whether or not there will be a penalty if you make your payments early. So the correct answer is going to be C, acceleration or due on sale clause. And these clauses, the acceleration clause is usually if you default on the mortgage, the lender can call your loan, meaning they can demand full payment of whatever you owe right away. And then the alienation or due on sale clause says that once you leave that property, so whether if you're selling it, transferring it, whatever you're doing, you're leaving the property, the mortgage becomes due and payable. Okay, so the correct answer is C. All right, question 4. Roberto, a first-time home buyer, is applying for an FHA loan on a $250,000 home. He has excellent credit and stable income. Which statement about his FHA loan is correct? A. Roberto must be a veteran or active duty military to qualify for FHA financing. B. Roberto will pay an upfront mortgage insurance premium and annual premiums regardless of his down payment amount. C. FHA will lend Roberto the money directly through local FHA offices. Or D. Roberto cannot get an FHA loan if he has sufficient funds for a 20% down payment. What do you say about this one? Okay, the correct answer is B. Roberto will pay an upfront mortgage insurance premium and annual premiums regardless of his down payment amount. Now, this is a feature of FHA loans. Once you get an FHA loan, regardless of your down payment, you're going to have to pay mortgage insurance premiums, right? So usually you're going to pay an upfront mortgage insurance premium at the closing, and then every month, along with your regular mortgage payments, you are going to pay mortgage insurance premiums as well on a monthly basis. All right. So it's not A because FHA loans do not apply to veterans. And it's not C because the FHA does not make loans directly, right? All the FHA does is insure. FHA insures the loan, but it doesn't give funds directly. And D is incorrect because you don't need 20% down for an FHA loan, right? All you need is 3.5%. All right, let's go to question 5. Captain Martinez is retiring from the military after 15 years of active duty and wants to purchase a $300,000 home using his VA loan benefit. Which statement is true regarding his VA loan? A. Captain Martinez must pay monthly mortgage insurance premiums for the life of the loan. B. Captain Martinez can obtain 100% financing with no down payment required. C. The VA will lend the money directly to Captain Martinez. Or D. Captain Martinez must occupy the property within 90 days but can then rent it out immediately. What's the answer for this one? Okay, the correct answer is B. Captain Martinez can obtain 100% financing with no down payment required. Okay, so this is a key feature of VA loans. They do offer 100% financing, and that makes them very, very attractive to veterans. Okay, so the correct answer is B. It's not A because VA loans never ever charge mortgage insurance. So A is incorrect. C, The VA will lend the money directly. No, that is incorrect as well. The VA does not lend money directly. The VA guarantees the mortgage, right? And D, Captain Martinez must occupy the property within 90 days, but then can rent it out immediately. That is also factually incorrect because if you get a VA loan, you have to occupy the property within 60 days of getting the funds. And also, you cannot rent out a VA property that is funded with a VA loan. It has to be your primary residence. Okay? All right, question 6. Linda is purchasing a $400,000 home with a conventional loan and making a 15% down payment, which is $60,000. Her lender requires private mortgage insurance or PMI. 2 years later, after making additional principal payments, her loan balance is $312,000. What should Linda know about her PMI? A. PMI is required for the entire loan term on all conventional loans. B. Linda can request PMI cancellation once her loan to value ratio reaches 80% or below. C. PMI is automatically canceled when she has paid for 5 years. Or D. Linda cannot cancel PMI until the loan is paid to 50% of the original value. What's the correct answer for this one? All right, the correct answer is B. Linda can request PMI cancellation once her loan to value ratio reaches 80% or below. All right, so this is a rule when you have a conventional loan, the borrower is able to request that the PMI be canceled once the loan to value ratio reaches to 80% or below. All right, it's not A because PMI is not required on the entire loan term or for the entire loan term. That's factually incorrect. That only applies to FHA loans. C, PMI is automatically canceled when she has paid for 5 years. That is factually incorrect as well. And D, Linda cannot cancel PMI until the loan is paid to 50% of the original value. That is factually incorrect. The PMI can be canceled once the LTV reaches 80%, and it should be automatically canceled once the LTV reaches to 78% and the borrower is in good standing, right? They are not in default. Okay? All right, question 7. David is selling his home, which has an existing mortgage balance of $180,000 at 3.5% interest. Buyer Emma wants to take advantage of this low rate. Emma will pay David $50,000 in cash, and the contract states subject to existing mortgage. 6 months later, Emma stops making payments and the lender forecloses, selling the property for only $160,000. Who is liable for the $20,000 deficiency? A. Emma only because she took title to the property. B. David only because he remains personally liable on the original note. C. Both Emma and David are equally liable. Or D. Neither party because it was subject to transaction and the lender accepted the risk. All right. All right, correct answer for number 7 is B. David only because he remains personally liable on the original note. Okay, so when you have a subject to existing mortgage, it means that the seller is going to remain liable, even though it is the buyer or the borrower who is actually making the payments. The seller is the one who is liable. Okay, so the answer is B. All right, let's move on. Question 8. Teresa owns her home free and clear, valued at $500,000. She needs $100,000 for her daughter's medical expenses. She arranges financing where she receives monthly payments from the lender. The loan balance increases over time, and no payments are due until she sells, moves out, or passes away. What type of financing is this? A. Home equity line of credit or HELOC. B. Purchase money mortgage. C. Reverse mortgage. Or D. Wraparound mortgage. Okay, the correct answer is C. This is a reverse mortgage. So a reverse mortgage is, as it says, it is reverse. So instead of the borrower making the monthly payments, it is the lender who is making monthly payments to the borrower, getting the funds from the equity that has accrued in that property. Okay, so this is a reverse mortgage. All right. Question 9. Michael earns $6,500 per month in gross income. He has a car payment of $450 per month, student loan payment of $300 per month, and minimum credit card payment of $100 per month. He's applying for a conventional loan where the lender uses a 28% housing ratio and a 36% total debt ratio. What is the maximum monthly housing payment Michael can qualify for? A. $1,820, B. $1,490, or C. $2,340, or D. $1,950. All right, let's see how you tackle that one. All right, so the correct answer for this question is B. So what you're going to do, so remember that the total debt to income ratio is 36%. That means that all the debts cannot be more than 36% of the gross monthly income. So you're going to take your calculator and you're going to put in the 6,500 and you're going to multiply that by 36% and you should get $2,340. Okay, so that's the maximum debt that this family can take on. All right, but they already have debt of 450, 300, and $100. So we're going to subtract those payments to see what is left, and whatever is left will be the maximum monthly housing payment that Michael can qualify for. All right. So 36% of $6,500 is $2,340. And then we're going to subtract the $450 car payment. Then we're also going to subtract the $300 for the student loan. And then we're going to subtract $100 for the credit card payment. And when you do all of that, you should end up with $1,490. All right, so the correct answer is B. All right. All right. And finally, number 10. Patricia is obtaining a $320,000 mortgage at 4.5% annual interest. Her first monthly payment will include principal and interest. How much of her first payment will be applied to interest? And it says round to the nearest dollar. A is $1,200, B is $1,440, C $1,620, and D $14,400. All right, let's see what you get for this question. All right, the correct answer is A. $1,200. All right, so for this question, it tells us that the mortgage is $320,000. The interest for the year is 4.5%. So based on that, we can go ahead and calculate the dollar value for the interest for the entire year. So we're going to plug into our calculator 320,000 times 4.5%. And you should get $14,400, right? But that's the interest for the entire year. They're asking you how much of her first payment will be applied to interest. So we just want the interest for the first month. So what we're going to do is divide the 14,400 by 12, because there are 12 months in the year, and you should get $1,200. All right. Okay, guys, so that's it for our mortgages, residential mortgages. If you love these questions and you'd like to get more questions like this, be sure to follow this channel, subscribe, and ask your questions. If you have any questions, feel free, ask them in the comment section, and keep following until we post our next video, where we will be covering another topic to prepare you for your Florida real estate exam. All right, bye bye for now.